Hello and welcome to the Margin of Sanity podcast. Today, I just want to give you an update on two of my key positions after Q3 earnings, Eagle Materials and Amazon. At first glance, you may be surprised that I've chosen to write about these two companies together, considering the seemingly fundamental differences between them. That said, rather than break down each and every figure for a quarterly report, I prefer doing that biannually. I thought it might be more helpful to reflect on both businesses in light of their polar opposite market reactions post-earnings. I recently had the pleasure of speaking with Siem from the Dutch Investors, and he described his personal investment focus as things that don't change. This statement perfectly echoes the very point of my first ever write-up on Substack, Thoughts on the Market, amidst the infamous Liberation Day tariff selloff. At that time, seemingly every conversation was around two subjects. How will AI change things? And how will Trump and tariffs change things? In that write-up, I listed a myriad of things I don't know, as well as a few things I think I do know. And I suggest you get a few eye rolls in now, preemptively, as I'm about to quote myself. So this is from April 24th, 2025. Quote, "So I asked myself, what do I know? I know America will likely need more cement and wallboard in the future, and that Eagle Materials, a newer position of mine, can survive a pretty heavy downturn. I also know its price is cheaper than it's been in quite a while. I also know it has cash to buy back shares at this cheaper price and will likely do so. So I've bought more of this position that I already owned. A company I've already decided I want to own for the long term, at the price I paid for it or cheaper, and it's definitely cheaper. I know people will still want fast delivery, lots of choices, and cheap prices. I also know about 4 million businesses run on AWS, and that Amazon earns high margins on that revenue. I know Amazon is 20% cheaper than it was a month ago. I know no rational person in America, Europe, or even China wants a global slowdown, trade war, or God forbid, a hot war." End quote. This wasn't foresight. It was just common sense. None of that has changed so far. Last quarter, Eagle posted slightly better than expected earnings and the stock rose. And Amazon's AWS simply failed to surpass the growth rates of Azure and Google Cloud. And so the stock fell. This quarter, Q3 2025, the opposite happened. As I write this, Amazon has just reported earnings, and the stock appears to be bound for a double-digit day of green. Eagle has also experienced double-digit price moves since earnings, in the other direction. None of this really matters, and I guess that's my point. But there are a few things I want to touch on from the earnings reports. Amazon's ads business. Let's forget AWS for a minute. Through decades of aggressive investment and capital allocation, Amazon has managed to build not just an e-commerce company, but a logistical powerhouse. It invested shareholder dollars in building out the necessary infrastructure to provide remarkable service to now about 220 million people worldwide in the form of Amazon Prime. In doing so, Amazon's competitive edge in e-commerce is unparalleled by any company that doesn't have its own airplanes, trucks, vans, and warehouses. On top of this infrastructure is an online everything store with every product you could possibly imagine, all at the best price you're going to get. I know, we all know what Amazon is, jackass. All right, fair enough. But one very interesting part of Amazon's business that has somehow been buried in the news of AI, Trump, and self-driving cars is this mega-cap online retailer/computing powerhouse moving into the ads business. Can you imagine a better data set for an advertiser than someone's Amazon Prime history? It's one thing to know what someone is interested in, Meta, and it's another to know what they're interested in buying. That is a powerful distinction if you ask me. At some point, I'll write about how Amazon's total addressable market is still gigantic in e-commerce and how they're not even profitable in many geographies yet. But really, I just want to mention the part of the Q3 release that grabbed my attention. Quote, "Announced partnerships that allowed advertisers to buy ad space on Netflix, Spotify, and SiriusXM Media through Amazon Ads." I wonder why advertisers would want to run ads on Netflix and Spotify through Amazon. Could it be that Amazon runs the world's largest online retailer, and that this means they know a lot about consumer behavior? Or perhaps it's that Amazon also knows what people listen to on Audible, or read on their Kindle, or watch on Prime Video? Or is it because Amazon happens to also be the place where people might buy your thing to begin with? Meaning, an advertiser could learn that I'm interested in buying a grill, play me an ad on Spotify because I watched Meat Eaters on Netflix, and then show me an ad for their grill on Amazon. Would that not constitute a game-changing value proposition? All I know is that the ads business is growing at over 20%. In Q3, sales were $17.7 billion, which amounted to a 24% year-over-year growth rate, with what I can only imagine must be very high margins. The ads business seemed to come out of nowhere, but it's such an unbelievably obvious move. It's not just running ads on Prime. It's, partnerships that allow advertisers to buy ad space on Netflix, Spotify, SiriusXM Media through Amazon ads. This makes me happy, and it's something I felt I needed to mention. Moving on to Eagle Materials. Still no houses, still no returns. If I run a risk with Eagle, it's going to be that I'm early. While their cement and aggregates business has had some very nice growth this quarter, their gypsum wallboard business did not. In the end, eventually home building will have to pick up. How, why, and when is another story, and one I tried to build a framework for in my 3-part housing write-up. If you're interested in learning more about housing and affordability, that stuff is all still free to everyone on my Substack. Eagle divides their reporting into 2 key segments: heavy materials and light materials. Heavy materials is essentially cement and aggregates, rocks. And thanks to a recent aggregates acquisition and cement sales volumes increasing by 8%, Eagle's heavy materials business has grown quarter over quarter, but not enough to offset the decline, both in volume and price, in the wallboard business. Big freaking surprise. If you hadn't noticed, people aren't buying homes right now. It's a bad time for home building, which is why I've been sniffing around this area. The thing is, Eagle is totally fine. They have plenty of cash coming in, which they're spending on buybacks, dividends, and improving operations. This is the beauty of a business which, 1, operates in multiple geographies, and 2, operates in 2 different markets, cement and wallboard. It's this sort of operational flexibility, together with owning their own gypsum and limestone mines, that keeps Eagle profitable in the down cycles, which is where they are today. Do I wish housing would rebound? Sure. But in the meantime, it's actually easier for Eagle's management to deploy capital efficiently. The stock is cheaper, the competition is vulnerable, and they can afford to take some time for maintenance and upgrades in key facilities. All of this means that when the tide shifts on housing, Eagle will be in a better position than it was before the tide went out. Not only are they not swimming naked, but they have a bathing suit with pockets to stuff fish and shrimp into. If I'm wrong, it'll be because I'm too early. We shall see. Both of these companies operate on a fundamental principle. Some things don't change. Things like force equals mass times acceleration, the equation which defines Eagle's moat. See the betting on cement write-up if you want to learn more about that. And the mere fact that everyone on Earth wants to buy things cheaper, faster, and easier. If you haven't taken a listen yet, check out the first ever Margin of Sanity interview podcast where I talk to Ozeko about something else that doesn't change: humanity's need for electricity. Stay tuned for another podcast with the incredible AK coming on Friday, where we'll talk about Caspi. And keep an eye out for a new Margin of Sanity deep dive on oil. I'll also likely do an update on coal as earnings start to roll in for those guys. Much love, Margin of Sanity.